Good morning. Thank you for joining me for the Whittier Trust Actionable Ideas presentation series. Today's presentation is an unbiased look at the electrification in a time of disruption. My name is Danielle Delmar, and I'm privileged to introduce you to your presenter and my colleague, Caleb Silsky, Chief Portfolio Manager at Whittier Trust. As I'm sure most of you are well aware, Whittier Trust offers holistic solutions to high net worth families across the US. Our portfolio management team, jointly led by Caleb, is just one of the core reasons that after 30 years, Whittier Trust continues to earn our clients' confidence and trust. Caleb's been with Whittier for 15 years, joining the firm in 2006. Caleb is a CFA charter holder, has a graduate certificate in financial analysis and valuation, and an MBA from the University of Southern California. Based here in our Newport Beach office, Caleb is a board member of the Crystal Cove Conservancy, where he combines his two passions being in nature and youth education. This presentation is scheduled for approximately 45 minutes. During the presentation, please feel free to ask questions via the question function on your screen. We will leave time at the end of the presentation to answer as many questions as possible. Should Caleb not get a chance to answer your question, we'll be sure to send you an email afterwards. Caleb, over to you.
Danielle, thank you so much, and thank you to everyone who has called in and is listening today. Being a longtime portfolio manager at the firm, I came into the office this morning and I checked Bloomberg and I checked FactSet to make sure if there were, any market-moving events that I would be on top of that first as a duty to my clients. And the top headline was, "Markets are devoid of any directional movements." So I figure what a great day to take a step back and to talk about a very important topic, a long-term topic, about the electrification of the motor vehicle fleet in the United States and around the world. So the topic is electrification in time of disruption. We're talking about a shift that will affect so many industries, from manufacturing and tooling to infrastructure, from utilities to oil and gas, to industrial companies, pipeline companies. It's going to affect a very large portion of the market, and then also employers in the country and around the world. Not to mention all the technology that's going into this. So as Danielle mentioned, the goal of this is really just to provide a foundation for our research and for our clients over the next decade and beyond, so that as we have discussions around how this is going to affect the market, how this is going to affect different investments, and how this will affect the environment and then also infrastructure in the US. So that's the goal of the presentation. We're talking about 5 things today. So the first one is that disruption is happening at an accelerated pace across multiple industries. And I'll dive into that more deeply in a second. Then we'll talk about the 3 phases of battery electric vehicles in our mind. The first phase is where the investment that's made in battery electric vehicles exceeds the investment that's made in internal combustion engines. So you'll see BEV and you'll see ICE. We're not talking about beverages and ICE. It's too early in the day to talk about that. So the BEV is battery electric vehicle and ICE is internal combustion engine. Phase 2 is where the sales of electric vehicles exceeds the sales of traditional gasoline-powered cars. And then phase 3 will be when fleet mileage, so the number of miles driven around the world of electric vehicles exceeds that of a combustion engine. Finally, we'll talk about the impact on infrastructure, which, as you can imagine, there's so much that's been built up in terms of infrastructure over the past 100 years. And so what does that shift look like? Okay, so let's talk about disruption. Disruption is happening at an accelerated pace. This is not just about electric vehicles. Think about Netflix, think Uber. There's so many industries that are being disrupted, and it seems like it's happening faster and faster each year. So if you go back to the 1980s, right? If you had a new business idea, you would go into the bank and you would ask the bank for a loan. And the bank underwriter would say, when am I going to get paid back? When is the bank loan going to be paid off? Is it going to be 12 months, 18 months, 24 months? So what's amazing is if you look at the IPOs, the public listings of companies in the early 80s, 20% were unprofitable. 80% were profitable companies. That lasted for nearly the entire decade. And then today, it's the exact opposite, right? So rather than going to a bank and asking the bank underwriter for a loan, we're now living in a world of private equity and venture capital. Companies can be unprofitable for a decade or more. They can offer free services. Think about Facebook. Facebook was free for a very, very long period of time, meaning it wasn't even ad supported. Today, it's ad supported, still a free service, but an incredibly profitable social media enterprise. And everything from Google, again, to Netflix and Uber. So of the $857 billion in private market capital that was raised last year, about 60% of that was in the United States. So over 500 billion was raised in the United States. And that's just an awful lot of investment going into disruptive companies and disruptive technologies. So there's something called the S curve, or the adoption curve, where as new technologies are implemented across the economy and markets, it can take 10 years, 20 years, 30 years. So if you go back to the washing machine or the electricity or interior plumbing, it took a very long period of time. And as we get further along, you can see the VCR, the computer, the cell phone, the internet, those were adopted much, much quicker. So adoption curves are getting steeper, and we expect that to continue. So keep in mind this chart. This is an S curve or an adoption curve, and keep that in mind as we get further along in the presentation. All right, so let's talk about phase one. Phase one is the investment in battery electric vehicles exceeding the investment in internal combustion engines. And to start with that, let's go back to the framework that we would have had a couple decades ago. Let's look at revenue. Where is the cash flow? Where is the revenue? General Motors, Ford, BMW all generate north of $100 billion in revenue. Tesla, about $30 billion. On the next slide, we can see that if you look at market cap, so the value that's being ascribed to those four companies by the market, if you add up BMW, Ford, and GM, which are all worth less than $100 billion, if you add the three of them together and make one massive car company, and then you double that value, you would still be less than Tesla's value on a fully diluted basis. And of course, this is a wildly moving target, so day to day this changes, but you can see the magnitude that the market is placing in terms of faith in battery electric vehicles over internal combustion engines. So if you look purely at this, we would say that phase one, the investment has already exceeded that of the internal combustion engine. If you look at sales last year, they were up over 144% from, this is just Q1 of 2020 to Q1 of 2021. So battery electric vehicle sales up 144% year over year. If you look at market share, Tesla absolutely dominant in the United States. So this chart shows, it's a percentage graph on the left-hand side, and the light blue line is the percent of the market that Tesla sells in terms of battery electric vehicles. So 70% of the market. Not true in the rest of the world. If you look at China, Europe, and on a global basis, it's about 20%. So the Tesla is way ahead of the competition in the United States. Globally, it's much more competitive. So if you look at the top four producers, you have Tesla, and then the second one might be surprising. It's actually General Motors. And again, this is on a global basis. And you can look and see at the jump that occurred from Q1 of last year to Q1 of this year. So Tesla basically doubled, and GM increased 8 or 9-fold. So what's the next big splash? The next big splash is logically the Hummer, right? If you're going to start with an electric vehicle and your concerns on an electric vehicle is the range of the vehicle and the weight and the aerodynamics to make sure that the car is as efficient as possible, let's start with the Hummer. So the Hummer is the big splash that GM is coming out with. GM is also committed to having their entire fleet be electric vehicles by 2035. So why start with the Hummer? And you probably saw the news last week that Ford came out with the F-150 Lightning. Really incredible marvel of technology, right? 300-mile range and enough torque and horsepower to satisfy any rancher. So the Hummer, I think GM and Ford are both following the Tesla model, right? Tesla came out with a very high-end, expensive, but flashy car. And then they went down in terms of accessibility to the broader market. So GM and Ford are doing the same thing. They're starting out by saying, rather than starting out at a lower tier and trying to build their way up and prove themselves, they're starting by proving themselves, even though it's expensive and out of reach for most Americans and most consumers. They're proving that they're capable of competing at the highest level, and then they're going to work on making it accessible and affordable. Okay, so let's talk about global adoption and market penetration. So the United States, on the left-hand side, about 3% of sales are electric vehicles. Feels like it should be far more than that, right? With all the new models that we've heard about coming out, all the advances in battery technology, and yet 97% of the cars sold, which there were a lot of cars sold at the end of the pandemic, the 97% are internal combustion engines. So we're making progress, but still a very, very, very long way to go. Europe, ahead of the United States, 6% in the first quarter of last year, up to 8% in the first quarter of this year. And then China going from being behind Europe at around 5% to now more than 10% of the market being electric vehicles. So what's happening in China? This is very interesting. In China, the cost of a license plate is almost as much as the cost of a car. So think about that. So how is that possible? Well, in Beijing, for example, there's concern over both the environment. Pollution is a very big problem in Beijing. Congestion is also a very big problem. Traffic is very bad. So there was policy put in place where they would have a lottery system to be able to get a license plate. And the license plate costs around $80. Well, it got to the point where about 1 in 47 people would actually win the lottery to get a license plate, which meant that 97% of those that wanted a license plate and wanted a car couldn't get one. So if you did win the lottery and you got a license plate, you could sell it. And you could sell the license plate for dramatically more than what you paid for it. In some cases, you could sell the license plate for as much as it costs to buy a car. So how does this relate to electric vehicles? Well, in Beijing, they said, all right, if the pollution is a problem that we're trying to alleviate, we know that we're going to have to commit to electric vehicles over time. So let's exempt electric vehicles from the lottery system. Electric vehicles can have direct access to a license plate without going through the lottery. And that worked in terms of selling electric vehicles. So electric vehicle sales in China are up dramatically. You saw that on the last slide. And they basically doubled as a percentage of total vehicle sales in the country. Of course, now that they're starting to recognize that it doesn't help alleviate congestion. So congestion is still an issue. There's talk of pulling back on some of those policies. And you've actually seen Tesla sales start to come under pressure in China. Part of that is the government starting to rethink policy around license plates and exempting EV vehicles. They're starting to exempt at lower dollar amounts. The other factor is that there have been some safety concerns and protests over there as well. Okay, so let's look at the contribution from the consumer, from government, and then ultimately from corporations. So this chart on the light green line shows the percentage of spending that's coming from the government towards electric vehicles. And then the light blue column is the dollar amount of spending coming from the consumer, and the dark blue is the dollar amount of spending coming from the government. So you can see the dark blue column is actually increasing each year, and yet the light green line is decreasing and has actually fallen in half from 20% down to 10%. So the consumer is really taking over for government spending. Government spending sort of led a lot of the shift in fleets in terms of natural gas buses and electrification of certain transportation modes. It's going to have to come from the consumer to be really meaningful in terms of broad-based adoption. If we go to the next slide, you can see the corporations and how they're responding to this. So some amazing data here. I know it's a little bit small and maybe hard to read, so I'll just highlight the important points. Amazon announced last year that they're going to aim for net zero emissions by 2040. That's pretty incredible when you think about the number of packages that are delivered in your neighborhood on a daily basis, and to have a net zero emission by 2040. They committed to ordering 100,000 electric vehicles, the light commercial trucks that you see driving around your neighborhood. They committed to ordering 100,000 of those from a startup company called Rivian, which is actually down the road in Irvine here. FedEx, I think FedEx, the amount of transportation that they're involved in, FedEx, one of the top 10 largest air carriers in the world, they're going to transition to an all zero emission vehicle fleet and carbon neutral operations by 2040. And then down at the bottom, you can see Walmart, they want to electrify the entire fleet by 2040 as well. So some pretty big commitments from some of the nation's largest companies, and also companies that have a very big transportation footprint. If we look at the number of models available and then the range. So this chart, the blue dots at the top show the range of battery electric vehicles increasing now up to 400 miles in some instances. The number of models that are available, the light green column there, increasing pretty dramatically. So progress is being made in terms of the available options to the consumer, the range that's available. I think you'll find if you go out and try and buy an electric vehicle right now, Tesla's pretty far ahead. And so if you're not going to buy a Tesla, you may be disappointed relative to the performance of other vehicles relative to Tesla. Over time, that will shift, and you will see more options available to the consumer. All right, so what about cost of the battery? For this to really work, you need the cost of the battery to decline. Right now, it's about $10,000 per car. This projection, which is based on Bloomberg New Energy Finance, the year 2024 is where you start to see parity. So that gray line is the internal combustion engine. The light shaded green area is the cost of the battery. So each year, the cost of the battery is declining as technology improves. And by 2024, you have parity. By 2026, 2028, could actually be cheaper to own an electric vehicle. And of course, that doesn't even factor in all the incentives that are currently in place and will be in place, and or the taxes that may incentivize a shift. So we talked about the incentives with the license plate in China. Europe has a 50% car tax reduction if you own an electric vehicle. And of course, the current administration in the US talking about several different approaches to to incentivize a shift toward electrification. So what about charging? Is the investment in charging there yet, or do we still have to wait for that? So two charts here. On the left-hand side, you can see fast chargers. On the right-hand side, you can see slow chargers. And so about 70% of the world's chargers are slow chargers. About 30% are fast chargers. And you can see that it's disproportionately in China. About 800,000 charging stations in China. That's the light green portion of the column chart. Both the slow chargers and the fast chargers are mostly in China. So we'll come back to that in a second. I want to conclude the first section by saying that phase one, recall phase one is where the investment in battery electric vehicles exceeds the investment in internal combustion engines. We're there. This chart right here that you're looking at shows that in dramatic fashion. The number of SPACs and conventional IPOs in 2020 were dramatically higher than they were in the previous ever. And you can see over almost $30 billion of new capital into to new EV technology. That's in addition to all the existing auto manufacturers that are shifting over. So phase two. Phase two will be where the sales of electric vehicles exceed the sales in internal combustion engines. And at this time, we're going to ask a question of the audience. So in what year will you see an increase, will you see more sales of electric vehicles than sales of traditional gasoline-powered cars? Will it be 2023, 2025, 2030, or 2035? And again, this is global, so this is not just the US, this is around the world. In what year will you see more than half the fleet sold be electric?
For those of you who are wondering where to answer this, it should be on the right-hand side of your screen. And then also don't forget to input some questions for the end of the presentation. Caleb, when you talk about fast and slow chargers, what's the difference in timing between fast and slow?
So there's really three tiers of charging. There's tier 1, tier 2, tier 3. Tier 1 would be essentially just plugging it into an outlet at home. And it could take 24 hours to charge a car on tier 1. Tier 2 is still plugging it in at home or at work, but it's with a converter and a slightly faster charger, probably 240 volt panel. And that could take, that could be six hours or so. The fast chargers, instead of taking alternating current and converting to direct current, fast chargers start with direct current and they transfer over to direct current. So instead of AC to DC, it's just DC to DC. And that can take anywhere from 45 minutes to, in some cases, less than half an hour. And that's generally going from 20% charge to 80% charge. Most cars do not want you to go above 80% charged and do not want you to go below 20% charged.
Great. We'll wait a couple more seconds for a few more people to respond. We've got a good percentage of people responding at this point. Okay.
So I see some optimists out there. There are a couple people responding that by 2025, you would see more than half the cars sold globally that would be electric vehicles. All right, here are the results. Mm-hmm. So about half the audience believes that in 2030, you'll see half the cars that will be sold will be electric. About a third, 36%, show 2035, and 14% show 2025. So very optimistic crowd. I'm also an optimist. We at Whittier are also optimists. But the projection is actually 2037. So that's not our projection, that's the Bloomberg New Energy Finance projection. And you can see on this chart that while the battery electric vehicle sales will grow exponentially, you will still see a lot of internal combustion cars that will be sold. As I mentioned earlier, last year about 97% were not fully electric in the US. And so again, plug-in, I think worth mentioning plug-in hybrids here. Plug-in hybrids will be a small percentage by 2037, but it's mostly going to be either battery electric or still some legacy internal combustion engines. So longer than most would expect. And we thought the poll results would show almost exactly what they showed. Most people would think it'd be around 2030, but that is an optimistic view. Consensus is further out, 2037. Okay, so let's go back to the S-curve that we talked about, the adoption curve. So what does that look like? It looks like, if you look on the left-hand side, that by 2023, in 2 years, China will reach 15%, and that the US reaches 60% in 2040. We, just like the audience, believe that that will happen faster. We think that this will be, the adoption will be slower than you expect over the next two years or so, and then it will be more sudden than this projection 5 to 10 years from now. The reason for that is, as I said earlier, if you look at different models that are available, there probably isn't, exactly the car for most people at this point outside of what Tesla has to offer. The Hummer, which I know everyone on this call has now, is researching on their phone on the side. It's already sold out for 2021, so it's a limited edition. And the F-150 Lightning will be expensive, first of all, and probably will sell out. So we think that the adoption will be a little bit slower, but then will be steeper than what these curves project. All right, so the next slide shows it is a very big task to convert the entire fleet. Right, so if you look at existing car fleet by region, mostly, more than half is the US, the EU, and China. It's 1.2 billion cars that are on the road right now. A lot of those cars will last for another 10 years, right? So to shift the entire fleet will take a very long time. And you can see that by drivetrain, I had to put an arrow in to show to indicate the amount that's actually electric vehicle at this time. It's just the vast majority of cars are internal combustion engines. It will take a long time for that fleet to roll over. All right, so that is the question for phase 3. When will the total fleet mileage of battery electric vehicles exceed the fleet mileage of internal combustion engines? If we said that more than half the cars sold would be 2037, and again, not our projections, but the Bloomberg projections. So we have to go well beyond 2040 to see when you have parity there. So you'll see an increase in electric vehicles that are sold, and you'll see a decline in internal combustion engine vehicles that are sold. But even when we get to parity, where more than half are electric vehicle sales, even at that point, you're going to have a long runoff of the existing fleet. All right, so let's talk about the impact on infrastructure. So we know that there's a lot of infrastructure that's been built out over the last 100 years. And that can include everything from the gas station to the refueling stations to the pipelines. There's a lot that can affect infrastructure. Danielle, if we could slide to the photos of the gas station, you can see what that looks like in terms of multiple pumps. There's a reservoir that has to be built into the ground. And on the next slide, you can see that there are 168,000 gas stations in the US. There are about 40,000 charge points. That's from the Department of Energy. I've seen other numbers that show a higher number of charge points. I think that's a hard thing to measure because of people charging at home and other areas, but at least 40,000 charge points. At any rate, it's a lot to keep up with. And if you're like the rest of our team, you're probably thinking right now that this is a big challenge on scale with the great horse manure crisis of 1894. I'm sure that's what you're thinking. So at that time, you wouldn't log into FactSet or Bloomberg, but you would pick up the newspaper, and the newspaper would have said, in 50 years, every street in London will be buried under 9 feet of horse manure. That was the projection at the time. New York had a population of 100,000 horses that produced 2.5 million pounds of manure every day. And of course, the answer to that was, let's bring in more horses to clean up the manure, but then those horses created more manure. So you can see that we do a similar thing where when a gas station runs out of fuel, Danielle, on the next slide, you can see that we actually bring in a tanker that fuels up the gas station. So you're consuming fuel to then replenish fuel. So we've certainly cleaned up worse before, right? In the late 1800s, this is certainly possible. All right, if you include Biden's 500,000 charging stations, so the widely talked about infrastructure plan that is still going through Congress at the moment and will likely look quite different when it's finished, includes incentives for building out 500,000 charging stations. And again, important to note that when you're looking at gas stations, 168,000 gas stations, of course, there's going to be multiple pumps at each gas station. So there could be anywhere from 4 to 20 pumps at a gas station. So multiply that number by 10, you get to 1.5 million. So it would still take a long period of time to have similar infrastructure in place. One huge takeaway that we had from putting this presentation together is that the infrastructure does not have to be replaced in real time. It can be built out in a complementary way, right? So you can still have the gas stations, and then separately you can have charging stations. So the cost of a gas station is about $500,000, anywhere from $500,000 to $1 million. The cost of a charging point, if you go through ChargePoint, could be as little as $5,000. So $500,000. So you have about 100 times shift in the cost. Charging point about 100 times cheaper. So what is this going to look like? What's the infrastructure going to look like? Is it going to be like we see in China, where this is a taxi charging station where you have hundreds of cars, taxi drivers that are laying down, checking their phones. They charge for about an hour, and then they go and drive for about 10 hours. It's possible that it looks like this. I think very, very unlikely that American consumers would tolerate any type of this type of living standard. So what's much more likely is that you would plug in when you're going grocery shopping, right? Plug into Whole Foods. You plug in when you go to the doctor. So you're in the waiting room, and the longer it takes to get your appointment, the more charged your car is. So that's, you're being productive. It could be when you're getting coffee. You're plugged in, you run in and get your coffee, and your car is more charged. Let's spend a second on this one, though, because if you're Starbucks, you already have the problem where somebody comes in, buys a coffee for $2.40, and then stays there for 2 hours or 3 hours, consuming up valuable real estate. If you incentivize people to come and park their car there, yes, you're going to help drive some revenue and some sales because people will potentially go there for lunch or for breakfast, but it also means that your turn rate goes way, way down, and you're giving up very valuable parking spots. So think about the convenience-oriented locations of Starbucks. It's not really congruous with having longer-term charging stations set up there. So we actually don't think that this is the way that it ultimately goes. We think that a lot of the charging has to be done from home, from work, and then from places where you might park your car for longer periods of time. Ideally, fast charging stations at grocery stores and fast charging stations at doctor's offices, but not necessarily convenience store locations. All right, so the next question is, how does this affect the grid? Right, we already have rolling blackouts at certain times of the year, in summer in New York and California. So this slide is actually pretty optimistic. Because of energy efficiency, the increased energy consumption, excluding electric vehicles, is de minimis. In some cases, we may actually become more and more efficient where we're consuming less energy because of LED lights and more efficient HVAC and insulation and all of that. So going out to 2040, if you believe the prior, the S curve, in the US, you would only see a 10% increase in electricity consumption. 10% over 20 years, that's half of 1% per year, very manageable. Europe, you'd see 9%, China, you'd see 7%. So we actually think that it is manageable for the grid to take on significant infrastructure in terms of charging cars. What about the impact in the oil market? Of course, we showed that more than half the cars miles driven will still be internal combustion engine out to 2040. Again, we're going to take the under on that, but let's say that that's a projection. You'd still be, the vehicle fleet would still be consuming the same amount of oil in 2040 as we do today. So you'd see an increase in the fleet expansion, you'd see improvements in fuel economy, you'd see a shift towards alternative drivetrains, meaning hybrid or electric, and you'd see an increase in shared and autonomous driving. But at the end of the day, there's still going to be a fair bit of oil consumption going out the next couple of decades. It's important to look at the different countries' commitments to net zero emissions. We talked about Amazon and FedEx earlier. Let's look at these different countries. So most of Europe, what's important is China by 2035 has committed to 100% electrified sales. So that's going to significantly help that adoption curve go much steeper. And then these net zero pledges from Sweden and Canada and Norway and the UK out to 2045, 2050, meaning that a net zero pledge would be if you do use any fossil fuels, you're doing some sort of carbon capture, or you're planting trees, or you're doing something to offset that use of fossil fuels. All right, so time for another question. So what is the top barrier to EV adoption in your mind? Is it and so think about your own consumer preferences, but then also think about what's going to drive, be a concern for your neighbors and other people in your community. Is it the lack of charging locations? Is it the lack of appropriate model type to fit your needs? Is it the upfront cost, the capital cost of buying the car that's more expensive? Is it the inconvenience, the charging time that takes to charge the vehicle? Or is it the uncertainty around what policy is going to be? Are we committed to electric vehicles or not? So we'll give a minute to see what the response is to these questions.
Thanks, Caleb. We're sitting about 40 minutes into the presentation, so we've got about 5 more minutes left, and then we're going to have plenty of time for questions. So just a reminder to everybody to put your questions in while you can. We have quite a few already, but we'll be happy to answer those at the end of the presentation. Okay, so looks like about a third would say the lack of charging locations being, that's really the primary concern, tied with the amount of
time spent charging. So it's location of the charge points and then the time you're going to spend at those charge points. If you combine the two of those together, it's about 60%. That seems to be the biggest concern. The upfront cost of the car, about 25%, and then 12.5% is the lack of the appropriate model type. All right, so let's see how that compares. Those are the top 5 barriers to EV adoptions. About 2/3 of people say that the lack of charging is their biggest concern. So that will be helped dramatically by the increased number of charging locations. Another large number, so 64%, say the lack of model type or appropriate EV type. 58% say the capital cost, so the upfront cost, and then 54% the operational change impacts, meaning the charging time. And then only 28% say the uncertain or underdeveloped policy landscape for EVs. So we're past the point of no return, right? We are shifting towards electric vehicles. It's happening around the world. And all of these 5 barriers, when we look at these 5 years from now, will be dramatically lower. All right, so to summarize, what did we talk about? We talked about the disruption that's occurring across multiple industries. And disruption is happening in an accelerating pace. It's happening because of technology, because of venture capital, because of private equity, because companies can stay unprofitable for very, very long periods of time and then disrupt entire industries. We talked about the 3 phases of the electric vehicle adoption. The first one being where investment exceeds investment in internal combustion engines. That's already happened. We're already there. The second phase is where the sales of electric vehicles exceeds those of traditional gas-powered cars. And the expectation is 2037. Our audience, 2030. At Whittier, we're going to be in between the two. So sooner than 2037, probably not as soon as 2030. And then phase 3, where the fleet mileage exceeds that of internal combustion engines. Expectation is past 2040. Again, we think that will happen sooner than projections, but is still not going to occur in this decade. And the impact on infrastructure, we talked about how you can have a combination of gas-powered and electric vehicle supported infrastructure. And I would say this, I'd say it's far easier to go from a gas-powered infrastructure society to an electric powered infrastructure versus the other way around. If we were all electric and we said, all right, now we're going to shift and we're going to power the fleet by gasoline and we're going to have to set up all the gas stations and pipelines. And so all the infrastructure we built out in the last 100 years is far more difficult than the infrastructure we're going to build out over the next 10 more years. It's much easier to build local charging points, much cheaper. And so very optimistic from that point, from that perspective.
Okay, thanks, Caleb. That's fantastic. We've had quite a few questions, and a lot of them have a similar theme. The environment, the impact on the environment is definitely one of them. This question, though, is in the enthusiasm for electric vehicles, do you think adequate recognition is given to the environmental costs of producing the battery or generating the needed electricity for charging?
Well, there have been several studies about that, and while the electric vehicles are not going to be perfect, right? To get the lithium that goes into the battery, we're going to have to mine that. Anytime you do strip mining, that can be environmentally damaging. We'll start out. There's sort of 2 ways of mining lithium. You can do it through brine, which is relatively cheap and relatively easy. Then you can do it through hard rock, which is much more carbon intensive. So by no means is anyone saying that electric vehicles are going to be 100% environmentally clean and there's no environmental impact. But there have been several studies that show that on a net basis, that the environmental impact is far less of having electric vehicles versus gasoline-powered vehicles. And as you get more and more efficient, where, at some point in the future, we'll be recycling lithium ion batteries. We're not doing that yet, and we need to do that. I was talking with good friends earlier about this topic, and they said, well, what if we shifted the entire fleet tomorrow to electric vehicles? Wouldn't that be great? And I responded, I don't think we're ready for that, right? I don't think the grid would be ready for that. A lot of the power that is generated through the grid is still from natural gas. In China, a lot of it's from coal still. What would you do with all the batteries? What would you do with all the gasoline-powered cars? So from an environmental perspective, doing it overnight would actually not be that great. But I do think, in answer to your question, there's very little doubt that on a net basis, electric vehicles will be better for the environment than gas-powered vehicles.
Is there enough lithium to handle the demand for electric vehicles?
There is, yeah. So there will be periods of shortages and maybe some periods of glut. We have seen prices fluctuate a fair amount. There are a number of companies that have spent 10 years researching how to mine lithium and where to mine it. There's a big mine that will occur in the United States, in Nevada. It's called Thacker Pass, just north of Reno. And there's about 6 tons of lithium that's there. Chile, Argentina, Australia also have very big reserves. So you're talking about tens of thousands of metric tons versus or tens of millions of metric tons versus where we are today, where we're producing 80,000 a year. So there is plenty of lithium. There will be pockets of shortages depending on how that S-curve manifests itself, but there is an adequate supply of lithium. And I think there's an argument to be made that by 2040, we're using a different battery technology, that we're not using lithium anymore. So there's a lot of experimentation on solid state batteries and shifting technology. So for the next 10 years, we would not expect to see a material shortage in lithium. There might be some bottlenecks in terms of bringing it out of the ground. And there will be probably some environmental concerns around that. But over the long run, there should be adequate supply and or maybe a different battery technology that comes out at that time.
So more than one of our audience members have asked about hydrogen as an alternative fuel source. Can you talk a little bit about that for them?
Yeah, so there are some vehicles that are powered by hydrogen. We have a colleague who passes by a hydrogen fueling station on his way to work every day and sees a long line there. To build out that infrastructure alongside the electrical charging point infrastructure would be very difficult. So I would say it's more likely that you see hydrogen play out in maybe the trucking fleet, or in maritime transportation, or even aviation. I think the passenger vehicle fleet will be predominantly electric and will not be hydrogen based.
Okay, so we've got time for a couple more questions. One of the questions we have is, can you comment on the fact that raw material and basic components for batteries are almost 100% produced in China? How will that impact investment in this area and the overall cost to the consumer? And
I'm not sure that's entirely true, but obviously Gigafactory in Sparks, Nevada, and then another Gigafactory in Germany, which we already talked about, where the lithium would be derived. I think there's a lot of commerce around the world that is dependent on China. So that could be an entirely separate presentation. I guess I don't necessarily want to comment on a lot of that at the moment. Okay. But I would say that there's a lot that goes into it that's actually outside of China. So more than the iPhone and probably most people on this call, if their iPhone was down for a week versus their car being delayed 3 months, having to live with the old car for 3 more months, they'd probably take that over being without their iPhone for several weeks. And it would probably happen at the same time.
So when one of the slides talked about there being not a huge impact on the electrical grid with the increase in electric vehicles, one of our audience members has asked whether or not there'd be any other investment in the electrical grid required because of the increase in using electric vehicles.
Absolutely, right. There's going to be ongoing maintenance, and then there's going to be, there's obviously a big push to all alternative sources of power as well. There are a number of charging stations. As I said, the fast charging is DC to DC, right? So you really want that direct current. So there are some prototypes out there where there's solar power that's directly powering the charging station. And then because it's DC, it's stored in a battery at anyways. So you're going to see, more solar farms. You'll see more wind investment to increase the power and the power available in the grid. And then the huge shift will be, being able to store that power. So you have variable sources of power that are a problem because, the way that the electrical grid works, you have sort of base load generation. You have a lot of power demand during the day, not very much at night. Charging cars at home is very helpful from offsetting that because you can charge at night when power demand is already lower. And so it's cheaper at that time as well. But there's going to have to be increased storage of energy, right? Right now, because of the way baseload generation works, we overproduce energy for most of the day to avoid blackouts. If we could store energy effectively and translate that into to power at a later time, then you wouldn't have to overproduce energy. So absolutely, there's going to be a lot of investment in the grid, both maintenance and then also alternative sources of power and storage.
Okay, so I have one more question for you.
All right.
So do all cars in the United States use the same charging connection? So this is a little bit along the lines of your previous talking about Apple and your car all going down at the same time. We have that issue with Apple constantly changing the charger or being their own type. What's going to be what's going to happen with cars?
Yeah, so this one that's a very, very interesting question, right? It's similar to the charging adapters and the headphone adapters you have on your phone, where why don't we just have the same adapter for everything, right? So there's been a concerted effort to have all electric vehicles, at least in North America and the United States, to have the same charging connection. And there's a little bit of a nuance between level 1, level 2, level 3 charging. You couldn't have the same adapter for all three, at least at the moment. But there is basically almost every auto manufacturer is on board with that, except for Tesla. Tesla has their own separate charging connection. So the network that Tesla has built out of the very fast charging station network they have cannot be used by other electric vehicles. It can only be used by Tesla. Tesla has a connection adapter, so they can use the what's called CCS, which is the combo charging system adapter. So if you have a Tesla, you can use ChargePoint, or, of course, right? But if you're a company who's manufacturing charging stations, you need to be able to satisfy the Tesla customer base. But it doesn't work the other way around, where Tesla has their own unique network and their own adapter. So in terms of how the Biden administration funds that and incentivizes growth in charging stations, it'll be interesting to see. I would be surprised if they allowed, incentivized Tesla to build charging stations that were not available for other vehicles. So that will be very, very interesting to watch.
Great.
All right, if that's the last question, I will say thank you for spending an hour on a Tuesday. I really appreciate the time spent here. A great topic, I think, very, very interesting. This is something that we can look back on in 5 years and in 10 years and say, how off were projections? Was the audience smarter than the Bloomberg NEF forecasters? And I would bet that the audience will probably be closer to being correct, that this will happen earlier than the Bloomberg NEF forecast. So I enjoyed it. And if you have any follow-up questions, happy to take those offline and answer those in writing. And on behalf of Whittier, I just want to say thank you for being connected to our firm in whatever way you're connected, and look forward to seeing you soon.